Well, thanks, LJ, and thank you all for being here. When Genevieve ran off my bio, there's some academic affiliations there. You all remind me of some of the classes I taught. Everyone's sitting at the back. And I hope you're not doing crossword puzzles back there. And I promise I'm not going to call on anybody here. So what I'm going to talk about is the global economic outlook. I'm really going to focus largely on the US, but I'm going to talk a little bit about Europe and China and places like that, because that kind of includes, that accompanies about 2/3 of the global economy. So let's start with the US. Let's kind of level set here. Where's the US economy right now? So I'm showing you GDP growth rates. The bars are the sequential growth rates at an annualized pace. You can see it's a little bit volatile on a quarter-over-quarter basis. So if you smooth it out with the red line, that's the year-over-year rate. And in the fourth quarter, the economy grew 2.5%. Now, that probably doesn't mean anything to anybody, but just to level set here, if you go back to 2010 to 2019, that 10-year economic expansion, the economy grew on average 2.5% a year. So, we're doing what we were doing back at that period of time. Now, if I walk down Tryon Street here and I grab a lot of people and I say, so tell me about the economy, they're probably not going to talk about GDP because, unless they're economists, they probably don't really understand what GDP is. When I say talk about the economy, they're going to talk about the labor market. That's how most people measure the labor market. And if you look at the left-hand side there, again, smoothing out the monthly volatility, if you look at the red line, over the last 3 months, on average, the economy has created 237,000 jobs per month. Again, to level set, if you go back to the last expansion, we created 190,000 jobs per month on average. So, again, that measure is doing very, very well. And that's a net number. So every month, millions of people take a new job, millions of people leave jobs. And so if you look at what's happening on a gross basis, if you look at the right-hand side, the blue line would be the hiring rate. So this is the number of people who are getting hired as a percent of total payrolls. And then the red line is the number of people who are separating. They're either getting displaced or they're leaving voluntarily, again, as a percent of payrolls. And what you noticed is that's kind of like at a 10-year low right now. So you may have heard this expression, the no hire, no fire economy. So it's not like there's a lot of hiring going on. When I talk to businesses, I say, are you hiring right now? And they'll say, not really, unless it's for a replacement sort of purpose. Well, are you firing people? Well, no, we're not doing that either. Okay, but net, again, the economy is doing fairly well in terms of creating jobs. And this job creation, what that is doing, these two lines, I'm showing you year-over-year growth rates. These are inflation adjusted. So the red line is consumer spending. So in December, consumer spending in inflation adjusted terms is up more than 3%. The blue line is what's called real disposable income. So that's income after taxes, inflation adjusted. Another way to say that is purchasing power. And you can see that that's at 2.5%. So all this job creation is creating a lot of income, which people then are subsequently respending. You look at inflation, inflation has come down significantly over the last 2 years. We're roughly at 3% in exactly 9 minutes. The inflation report for January will be released. We're expecting the year-over-year rates there to remain roughly the same, roughly around 3%. So the good news is it's not 9% anymore. The bad news is we're not quite back at 2%, kind of where the Fed would like to see it. But net, when you take it all in, this period of time right now, it's probably not as good as the late 1990s, but the U.S. economy is pretty darn good right now. I mean, to use a word that's been bandied around a lot, it's a little bit exceptional. It's growing really well, and inflation maybe is a little bit higher than we'd like it to be, but it definitely has come down. Now, there's some changes afoot in Washington, D.C., so let's talk about that a little bit. So again, just to level set, if you look at the left-hand side here, this is imports by different trading partners. So if you look at that lavender line, that's imports coming from China. And what you notice is, up in the last decade, that was our largest importer or source of imports, single source. was China. As you can see, that has come back down. What's our biggest right now would be the European Union. Okay, now yes, the European Union is 28 individual countries. I get that, but if you take the European Union as a complete trading bloc, that's our biggest source of imports. And then you can also see Mexico in there. That's kind of the crimson line, and Canada as well. And so, most of our imports are coming from these sorts of areas. And then if you look at the right-hand side, yes, our imports from China have come down, but if you look at all the way on the right-hand side, these would be bilateral trade balances. So our biggest bilateral trade balance remains with China. Our imports have come down, but we just don't export a lot to China either. We export about $100 billion worth of goods and get about $400 billion from China. And you can see, other than just a few of the countries on the far left, we run bilateral trade balances with most countries of the world because we do have a very large current account deficit. All right, so the T word, tariffs, is definitely in the news. And so let's talk about the effects of tariffs for a little bit. So last summer, when then candidate Trump was talking about tariffs, he was talking about a 10% universal tariff applied to all trading partners, 60% applied to China. And so we said, okay, so what happens if that happens? What happens to the economy? And so we have a large macroeconometric model that we use. We ran it through the model. And so if you look here on the left-hand side, can you see this red dot over here? Okay, so this is inflation. So the blue line is the baseline, the model's baseline forecast. And so if you look here at 2025, in terms of core CPI inflation, the baseline forecast is, let's call it 2.5%. If you put a 10% tariff on everybody in the world and 60% on China, you go from right here, 2.5% up to about 4%. Because what happens is, contrary to what some people will tell you, China does not pay for the tariffs. We Americans generally pay for the tariffs. I mean, the way a tariff actually works is the importer pays the tax. And then if the importer can push back on their foreign supplier, maybe the foreign supplier will pay part of that tariff. But generally, what happens is, and all the empirical literature that I'm familiar with shows that the domestic people, whether it's the companies or whether it's consumers themselves, actually end up paying for most of the tariff. Tariff is a tax. Somebody's got to pay the tax. And it turns out, generally, it's paid by domestic people. Okay, and so you get this jump up in inflation. And so what happens is, remember that chart I showed you? I talked about purchasing power. Okay, so now so let's say you're importing something from China, and just to make the math simple, let's say it's $50, and let's say it's a 10% tariff, and it gets completely passed on. So now that good is going to cost you $55. So you have $5 extra now to spend somewhere else. So $5 extra less to spend somewhere else in the economy. $5 doesn't sound like a lot, but when you multiply it by hundreds of millions of people and you do it for all sorts of goods, it really starts to add up. And so what it does, it's a hit to real income. And because of that, what happens is real consumer spending slows down. And so if you look at the right-hand side of the chart, now I'm showing what happens to GDP. Okay, so under the baseline, the model is predicting 2.5% GDP growth this year. 10% and 60% gives you this red line, roughly 1.25%. And then if you assume the rest of the world retaliates by putting their own tariffs on the US, now you're going down to 0.5%. Tariffs are a modest stagflation. So some of you folks will know this word, stagflation, right? Some of you folks remember the 70s. I'm not going to name names, you know who you are. It's not that bad. This is not, to paraphrase former Treasury Secretary Larry Summers, this is not the mother of all stagflations, but it's a modest stagflationary hit to the economy. It causes inflation to go up, it causes growth to slow down. And then you can see things kind of move back towards normal over time, okay? It's, a tariff when it goes on, it's just a one-time hit. It raises the price level, and when you go from point A to point B, that rate of change causes the inflation rate to go up. But once you get to point B, assuming you're not doubling down and continuing to put more and more tariffs on, the price level stops rising, and so then you come back to your previous inflation rate. It's kind of a one-time hit to the economy. Okay, so how do we take this? So this is what the model's predicting. How do we do this in our forecast? In my view, it wouldn't be prudent to take, and so this was 1060. Things have moved on since then. Kind of where we are right now is we have 10% tariffs applied to China, 10% more than what was under the Biden administration. That's in effect right now. The president has threatened 25% on Canada, 25% on Mexico, although he gave them a 1-month reprieve, and we're in that 1-month window right now. He's threatening tariffs on the European Union. He's put tariffs on steel and aluminum imports. All right. So here's the problem when you're trying to forecast all that sort of stuff. I think it wouldn't be prudent to take all those announcements and just run it right through the model and say, this is what's going to necessarily happen. You got to make some sort of guess about probabilities. Is this really going to go into effect or not? And are there going to be exemptions or not? So what we're assuming right now in our forecast is we're saying, okay, right now we've got a 10% extra on China. Our guess, and this is a WAG, W-A-G, it's a technical term, wild ass guess. Right? Our WAG here is that goes from 10% in Q1 to 25% in Q2. We just think there's tensions between us and China. And China retaliates with their own 25. Starting in Q3, what we're assuming is a 5% unit tariff on everybody. It kind of gives us some wiggle room, right? It's not, the president hasn't threatened 5%. He's talked about 10%. So what the 5% does, it says, okay, that probably allows some stuff to get exempted, and it gets some trading partners to be exempted. And so we're essentially saying we think half of this kind of goes into effect. And so what we see in terms of our forecast, if you look at the left-hand side here, here's our GDP growth rates. As you can see, we've got a slowing going on later this year. We're going from 2.5% down to 1 to 1.5% or so. It doesn't cause a recession, but it causes a slowdown in terms of growth. And then as you go into 2026, things start to pick up again. What we're assuming is that these are one-offs. It's not like, we go, we do 25% on China. China says, okay, we're going to do 25% on you. And then President Trump comes back and says, all right, I see your 25 and I'll raise you another 25. And China says, okay, we'll see your 25 and raise you 30. Right? We're assuming that doesn't happen. It's kind of a one-off sort of thing. We'll see, right? What happens there. But as you go into 2026, you get a little bit of a pickup because we're also we're in a, let's call it a looser regulatory environment right now. That should eventually be good for business fixed investment spending. And we're also assuming at the end of this year, Congress passes a tax cut that's roughly $1 trillion spread out over 10 years, $100 billion per year. That's our operating assumption. And so that's why you have a little bit of a pickup next year. In terms of inflation, I guess the way to think about this is inflation stalls. We're not going back to 2%. It doesn't spike up, but it kind of stalls out around 3%, and that will have some repercussions later on. Let me quickly talk about some fiscal policy sort of things. So here, if you look at the left-hand side, these gray bars, this is our federal budget deficit. Okay, so in fiscal 2025, which started on October 1st of last year, October 1st last year to September 30th of this year, the Congressional Budget Office assumes we're going to be running a 6% of GDP deficit. And to put that into level set that for you, look at this dashed line, that's the average over the last 50 years. On average, we've had a deficit of roughly 3.5% of GDP. Okay, and then this gray bars go out to over the next 10 years. Here's the trick, or here's the catch. When the Congressional Budget Office does its long-term forecast, It's not making any policy assumptions. It's not trying to guess what Congress may or may not do. It takes current legislation as is and then projects out. At the end of this year, the 2017 tax cuts expire. Okay, and so that's what's baked into that forecast there. The CBO is assuming, projecting that the tax cuts expire and that everyone's taxes go back up to pre-2017 levels. All right, if you go into reality, that's probably not going to happen, right? The tax cuts probably will get extended. You have a Republican in the White House, you have Republicans in both control both houses of Congress. The tax cuts will probably get extended. So if they do, then what happens is you're not collecting as much revenue. This gives you the blue bars. And then because we're going to have a higher stock of debt, the interest on that debt is higher. That's the red bars. Now you're looking at deficits as far as the eye can see of 78%. And then if you say, what does those deficits do to the debt of the United States? So right now, our federal debt as a percent of GDP is roughly 100%. Here's the end of the Second World War, just to put it in perspective. This is the next 30 years, the CBO baseline, okay? All right, so what's the issue? How did we get to this predicament? All right, so the blue line is outlays as a percent of GDP going back to 1974. The red line is revenue as a percent of GDP going back also to 1974. And then the dashed lines is the average over that period. Okay, so if you start at revenues, right now we're more or less at the long-term average. Okay, if you look at outlays or spending, I mean, this is what happened during COVID. This is kind of a one-off sort of thing. But what you see here is, even on a trend basis, this has trended up over time. Spending as a percent of GDP, that's where the issue is. Okay, so let's cut spending. That'd be easier said than done. Okay, this pinwheel over here shows you, this is for fiscal 24, the different parts of spending, all right? So this outer belt here, these blue things, is what's called mandatory spending. This does not require an annual appropriation from Congress. Things that are mandatory are things like Social Security and Medicare. If you think of Social Security, you hit 65 or you hit your retirement age, whatever it may be, you are automatically eligible to start receiving Social Security. Doesn't require an act of Congress. The same thing in terms of Medicare. The day you turn 65, you can start getting Medicare. Doesn't require an act of Congress. It's on autopilot. Now, Congress can go back and change the rules, can change the eligibility requirements, but this is more or less on autopilot. Okay, so here's Social Security. Last year, $1.5 trillion. Here's Medicare. Let's round up, call it $1 trillion. Medicaid, 600 billion. And then here's some other sorts of things that are also mandatory. This would be like veterans benefits, it would be ACA, subsidies, et cetera, et cetera. We'll come back to that. The red are things that require appropriations from Congress every year. And we're dividing this into two things. Defense, so the bright red, it's close to $900 billion last year. And then non-defense, just a little bit over $900 billion. And then net interest last year was close to $900 billion. Here's the thing. Medicare, Medicaid, Social Security, more or less untouchable, right? President Trump said, we're not going to touch those sorts of things. Medicaid, maybe, right? But Social Security, Medicare, out the window. Defense. Anybody going to really take a whack to the Pentagon in the current geopolitical environment? We could zero out the interest on the debt, just not pay the interest on the debt. That would probably lead to another global financial crisis. Okay, so Medicare, Medicaid, Medicare, Social Security, Medicare, Medicaid, defense, interest on the debt. As a percent of the total budget, roughly 85%. The other stuff, shucking and jiving. Doesn't really matter. Okay? Over here, this is discretionary spending. Defense, last year we spent 3% of GDP on defense. Okay? It's about as low as it can go. And non-defense discretionary, also roughly 3%. Not a lot of blood left in that turnip. And so, yeah, you can take $1 billion here, you can take $1 billion there. We're talking a $1.8 trillion deficit. I mean, it helps, right? But if you really want to do something about these things, guess what, folks? Where's the money? It's right here. Back in the 1930s, there was a bank robber. His name was Willie Sutton, I think. And they caught Willie one day, and they said, Willie, why do you rob banks? And he said, well, that's where the money is. Why do you have to go after mandatory spending? That's where the money is. The problem is it's all of us. You got to raise taxes, or you got to go after that stuff to really make a dent. The other stuff is kind of rounding errors. Okay, so what this means is, here's the Fed. The Fed has already cut rates by 100 basis points. We think they're on hold now for a while. Just because inflation is not back down to 2%, the economy is actually holding up pretty well. We have a rate cut, we're penciling in a rate cut for September and another one for December, because if the tariffs go into effect, as we think they will, and if things start to slow down and the unemployment rate starts to creep a little bit higher, we think the Fed gets a little bit concerned and does another 50 basis points of rate cuts. But the problem is, well, not the problem, but the thing is, unless we have another calamity, like another pandemic or another global financial crisis, we're not going back to 0%. Right? This is the old new normal. 0% interest rates, none of us up until 2008 have ever experienced 0% interest rates. That was weird. Same thing in the pandemic. We're going back to normal, where interest rates aren't at 0%. And then in terms of the long-term, showing you this, the debt, it's not like the long-term yields are coming down anytime soon. And so if you look at, I can talk about the 10-year Treasury security, probably doesn't mean a lot to anybody, but what does mean something to somebody is the yield on the 30-year fixed-rate mortgage, which is based on a spread over top of the 10-year Treasury security. I think you're looking at mortgage rates of 6 to 7% for a long period of time. Housing is getting to be unaffordable in many parts of the country, and I don't think that's changing anytime soon. All right, let's go quickly talk about the rest of the world. So if you look at exports to the United States, it's a really big deal for these two guys over here, Mexico and Canada. As a percent of their GDP, exports to the United States are equivalent to about 25% of the Mexican economy. And when you look at Canada, it's roughly 20%. Okay, just for comparison purposes, I'm putting the EU and China in here. The EU and China are huge economies. And again, I understand the EU is 28 individual economies, right? But there's a lot of trade within Europe. There's not as much trade with Europe with the United States. Europe's big trading partners are their own countries. And then China, it's a huge economy as well. And so it's here we're talking about, what's this, 2.5%, maybe 3% of GDP. It's something, but it's not like these other sort of guys right here. We talk about Europe, let's talk about the Eurozone. These are called purchasing manager indices. So the blue is for the manufacturing sector, and the red is for the service sector. The way these things work, we like to look at these because you get these on a monthly basis. They come out pretty quickly. So we already have the January PMI. The way they work is when the line is above 50, activity in that sector tends to be expanding. When it's below 50, it tends to be contracting. And what you're looking at right now is manufacturing a little bit below 50, services a little bit above 50 in general. And I'll show you the GDP numbers here right now. The Eurozone economy is growing, but it's growing pretty slowly. It's certainly not the 2.5% the United States is. Good news is inflation in the Eurozone has come down. If you look at they had an inflation problem like everyone did right after the pandemic. The inflation rate in the Eurozone is not back to 2%, but it's pretty close to that. The ECB seems to be pretty satisfied with that. And then what we did was we said, okay, so what happens to Europe if we do a 10% tariff on Europe and they retaliate? These are, so if you look over here, this is GDP. These are changes from baseline. And so on the year over year. So the worst it gets would be later this year, and it's going to slice off, according to the model, about 0.3 percentage point from European GDP growth. And I'll level set for that in just a second. And then what happens is it pushes up their inflation rate by a few tenths of a percentage point. And again, I think that makes sense when you look at, if I'm going to go back to this chart right here, obviously there's trade with the United States, but it's a relatively small part of the economy. So I wouldn't expect to see huge sorts of numbers here. But when you look at the Eurozone on a year-over-year basis right now, so whereas the US was growing 2.5%, the Eurozone is growing about only 1%. And if you slice off even a 0.25 percentage point, it's probably not enough to put it into recession, but it's you got another shock or two in there. It potentially could do that. The ECB has already cut rates by 125 basis points, and we're looking for another 100 between now and the end of the year. Just because growth is slow, inflation is back down to target more or less. And so whereas the Fed is only doing 50, we think the Eurozone, the ECB is looking more like 100 basis points. And that probably leads to a stronger US dollar over time. That's good news for anybody who wants to travel to Europe this summer. The dollar probably will remain fairly strong over there. All right, let's talk about China, and then I will shut up and answer any sort of questions that you may have. I put this in here. Is China turning into another Japan? So these are GDP growth rates going back to 1980. If you look at the red line here, here's the GDP growth rate for Japan back in the 80s. You can see it was growing 4 to 5%. And my data doesn't go all this far back, but I've seen other data sources. I mean, if you go back to the 60s and the 70s, Japan was growing double digits over that period of time, right? It was much like China back earlier part of this decade. The bubbles blew up in Japan in the late 80s, early 1990s, and the Japanese economy has largely stagnated since then. Over the last 25 years, on average, the Japanese economy has only grown 0.7%. And again, put it in perspective, go back to 2010 to 2019 for the US, it's 2.5%. And if I were to go back to the turn of the century, it's probably somewhere between 2.5 and 3 on average. And what you can see is the Chinese economy, it was growing like gangbusters earlier part of this century, but we're only growing roughly 5% right now. Another way China looks like Japan, here's their inflation. There is none. Japan, as if you probably remember, had a mild deflationary episode for much of the last 30 years. It really, they don't have deflation anymore. Thank God for COVID, in some sense. Right? It caused the inflation rate to go up in Japan. So they're not looking at deflation anymore, but boy, China is darn close to that. And then another way that China looks like Japan is, I think I showed you these charts last year. Here's the working age population. The more people you have working, the more widgets you can potentially make. The working age population in Japan topped out about 30 years ago. And if you look at the UN's projections, it's going to continue to slide. China has already topped out, and it too will start to slide. 2 or 3 years ago, they had this new thing. They're trying to encourage couples to have more than one kid. It's not really working. It's not like they have tons of immigration in either of these countries. And so you're looking at the working age population continue to go down. And then another, here is this is non-financial corporate debt. So this is the debt in the business sector. This is what it is in the United States. It's roughly 60% of GDP. It's been more or less trendless for the last 2 decades or so. Here's the business sector debt in China. So when you look at Japan, they have a very large government debt. China does not, but it's all in the business sector. And actually some of this are state-owned enterprises anyway. So it's more or less government debt. Looking forward in terms of tariffs, again, if we put, we have this tariff, it's going to slow their growth rate down. But they're growing 5% right now, so it's not huge. And then it pushes up their inflation rate a little bit over here. And then here's our forecast for China going forward. We don't see that economy blowing up anytime soon, but over the next 2 years, we think growth is going to average 4%. And if you say, tell me about 5 to 10 years from now, where do you think it's going to be? Knowing what I know right now, 2, 3, it's kind of stagnating. In my mind, China very, very much is another Japan. Okay, and then finally, the last thing I'll talk about, and then I'll open up for questions, is we look at we take everything globally. Over the last 40 years, 45 years, on average, the global economy has grown. It's 3.25% on average. 2024, it's still a red dot because we don't know exactly. It's an estimate. Let's call it roughly 3%. We think the next 2 years we're looking at below average sorts of growth. I mean, it's not a pandemic, it's not a financial crisis, it's not even the recessions of the early 1990s or the early 1980s, but it's kind of subpar sort of growth for the next 2 years. So with that, let me stop and just say, if you invite me back a month from now, or next week, this forecast could change, right? Depending on things that are happening in Washington. And it's a guessing game right now. The confidence intervals around our forecast are always relatively wide. Right now, they tend to be wider, just because of the policy uncertainty that's out there. So.
Wow. Thank you so very much, Jay. As I said, this is so illuminating and so edifying. We're very, very, very grateful for your time here, and thank you. We're going to open up to questions and answers, and as you state your question before that, please tell us your name and try to make your question as brief as possible, concise as possible. We're open. Mike McNamara.
So, Jay, thanks very much.
State your name, please, sir.
Mike McNamara, work with LJ. I really have.
So I'm going to see if I can squeeze 2 questions in. One I had before you spoke, and one comes from what you spoke about. The first one is, it's other than the pandemic period, we don't seem to have had a recession in some time. And there are it seems that we're managing the economy maybe better than we used to, because we used to have this idea of the business cycle where we had this growth, and then we had decline, and then we had growth, and then we had decline. And it seems that has leveled out some. Do you see a recession for the U.S. economy in the next, let's say, 2 to 3 years?
So, Mike, we did have, that's not here. I mean, the recession before the pandemic was the global financial crisis. That was a doozy, right? So I remember this very well. I remember in January of 2020, we were over at what we used to call One Wells Fargo, the top floor there, and got the question about if there's a recession, how does it happen? My answer at the time was, if there's a recession coming, it's going to be what we refer to as technically is known as an exogenous shock, something that you can't see at the time, right? So those of us of a certain age would remember the OPEC oil shocks of the 1970s, a war that comes out of nowhere. The example I used was, so there's this thing in China right now, it's called COVID, and maybe if that gets really bad, that would be a recession here in the United States. It's kind of the same sort of thing. So recessions happen one of 2 ways. Either you get an exogenous shock that nobody can kind of see coming. The other thing is when something in the economy gets wildly out of balance and then corrects, like too much housing, or in 1999, tech stocks. We had a tech bubble, right? And that corrected and it causes a recession. When I look around the economy today, I say, what's wildly out of balance? The big thing that's kind of out of balance would be our federal government debt, but I don't see a mechanism that causes that correct anytime soon. There's no alternative to US Treasury securities in the world. It's not Euro, there's not European bonds, there's German government bonds, there's Spanish government bonds, and what we learned 15 years ago is a Spanish government bond is not a perfect substitute for a German government bond. Japan's a great place to invest if you don't mind giving your money to the Japanese government for 10 years and expecting a yield to maturity of 1%. China, wouldn't touch it with a 10-foot pole. There's just no alternative to US Treasury securities. Now, if we do something stupid, like we default on our debt, Katie barred the door, right? That would be your next global financial crisis. So, I'm in the near term, I'm generally optimistic about the outlook for the U.S. economy. But we've got to do, sooner or later, people say, when's that going to be a problem? I have no idea. But it's not sustainable. You saw that debt to GDP ratio, that's not sustainable.
Well, that really was my second question. When does that, because that's a frightening situation where at some point, we seem to have run deficits as a country for a very, very long time and managed it. But that chart that you showed is frightening.
Well, I don't want to be a Pollyanna, but okay, so this goes up to 160% over the next 30 years. You know the Japanese government debt to GDP ratio is now? 250. Now, there's lots of differences between Japan and the United States. I'm not going to go into all those sorts of things. It's just, if nothing else, what that does is it may not cause a financial crisis, but it causes interest rates, long-term interest rates to remain elevated. And then that has issues for the housing market, has issues for capital investment, et cetera, et cetera. Well, Jay, you want to? They may not hear you in the back.
So the question I have, all this tariff war galore, which we're observing now, coming from Trump administration, can it be stamped by any action within WTO by the nations affected by such tariff? Because it looks quite a bit callous and out of order in terms of how the tariffs can be imposed within WTO. Or do you think that in his, according to his MO, Trump will just push for exiting WTO if he doesn't like this action?
You know what, I don't want to be flip here, but this is a line, I think, attributed to Joseph Stalin, not that we should be quoting Joseph Stalin, but, something about, the Pope, right? And he said, how many divisions does the Pope have? Again, I don't want to be flippant, right? The WTO can scold us all they want. Donald Trump is going to do whatever he wants, and, right? The only real sanction that the WTO has against the United States is to allow other countries, quote, allow other countries to put retaliatory tariffs on the United States. And they've already all said that. We're going to do that. China's going to do it. The EU is going to do that. They're not running the WTO. They ask for permission. They're just going to respond in kind.
Next question.
And one last thing I would mention here. You probably know this. The United States, the American president has a tremendous amount of unilateral authority when it comes to tariffs. Over the last 5 or 6 decades, the U.S. Congress has delegated to the president a number of different acts, just tons of authority. So what Trump is doing right now, it's not like it's outside of the law. He's citing different acts that Congress has given him over time in order to put these tariffs on a unilateral sort of basis. And there's not much that they can do about it unless they go back and change the law. I'm not expecting that.
Young lady from Queens, go ahead. Wait for the microphone and introduce yourself, please.
Hello, my name is DJ. I come from Central Piedmont Early College and Central Piedmont CPCC. And I have a question that I've had for a while that I'd like to ask. How do you think AI and automation will impact job markets and income inequality over the next decade?
That's a really good question. And so AI is going to be disruptive in terms of its effects on the economy, but it does not necessarily, and there's a lot of different opinions about this, but it does not necessarily mean all jobs out there are going to disappear. Or will there be some jobs that it will eliminate? Yes, for sure, but it also makes people more productive. Beforehand, I was talking to some folks out there, I'm not gonna, just in the interest of time, I won't go through it, but I'm starting to use a little bit of AI and generative AI in my work. It makes me tremendously more productive. And so that's a good thing. In general, what I would say is artificial intelligence, or more precisely, generative AI, is a productivity game changer. And that's important because productivity always lifts income for somebody in the economy. If it's the worker who is becoming more productive, the business can then pay that worker more. If the business decides not to pay the worker more, that goes right down to the bottom line, which is the income for the shareholders or for the proprietor who owns the business. And if you don't pay the workers more and it doesn't flow down to the bottom line, you can cut your prices, and then that becomes income for all of us. And so some people refer to artificial intelligence as, losing track, either the fourth or the fifth industrial revolution. When we go back and we look at history, those technological revolutions, in a long run sense, are always tremendously beneficial to humankind. Great Britain became the world power that it was in the 19th century because of the Industrial Revolution, starting there. And it would have been foolish if the Luddites would have succeeded in smashing all the looms and all that sort of stuff. And the same thing today. The worst thing we can do is put our heads in the sand and try to legislate away AI. What we have to do is we have to have the smart public policy. And I understand in today's environment that may be an oxymoron, but we need to have the smart public policy to make those adjustments. When people get displaced, that they can move into other parts of the economy. It's a game. It's disruptive. It's kind of scary, but in the long run sense, it's a productivity game changer, and it can be very, very beneficial.
Thank you, Steve.
I'm Steve Hoff. Your models don't appear to include any spending cuts. And I was just listening to CNBC yesterday, and Majority Leader Scalise said that the bill they're putting together will have $1 trillion in cuts, and probably over 10 years, I don't think he specified. And that DOGE was coming up with another $1 trillion in cuts, probably over 10 years, I guess. I'm curious, if you look at that wheel that you had showing discretionary spending and so on, where would that come from? And does your model assume that that doesn't happen?
So first of all, selling $1 trillion and taking the under on that. I think when the rubber meets the road, when they actually start to go down into it and we start to look at the different areas of spending it actually starts to touch, there's going to be a lot of representatives and senators who are going to say, you can't cut that program. People in my district depend on that sort of program. So we'll see. I'm skeptical about that. So if it's $1 trillion of cuts over the next 10 years, so let's say that happens, $1 trillion of cuts over the next 10 years, divided, that's $100 billion a year. Last year we had a $1.8 trillion deficit. Now we got 1.7. Wow! In terms of the wheel, I mean, where does it come from? Social Security, Medicare. Maybe there's some government waste. I mean, I think there's a lot of just noise going on. DOGE found $1 billion here and $1 billion there. Every night I go home and I go through my pockets and there's the quarter. I put it on that's kind of where we are in this terms of thing. And does it have a huge effect on so no, our model does not incorporate any of that. But even if it did, it would be a second order sort of effect.
We have time for 2 more questions, and we're going to go to Michael there and to the young gentleman there. Last question with you there. Michael?
This year you didn't talk about the shrinking middle class, income differentials, and equity differentials growing in this country. We talk about middle class now being 40%, but we don't talk about low income and poverty growing from 20% to 40% of this country. And with that, the growing consumer debt. We talk about national debt, but there's what's going on with consumer debt and the shift in income.
So let me address the second part of that question first. If you look at household debt measured as a percent of disposable income, people refer to that as leverage. Today, that number is roughly 100%. At the height of the housing bubble, it was 130%. If you go back to when the housing bubble, before the housing bubble started to inflate, it was 100%. If you look at the debt service ratio, so this is the amount of income I have to spend, or we as the households have to spend to service our debt. That's the amortization payments and the interest payments. That's roughly 10%. Back during the housing bubble, that was at 15%, and this is more or less at a 40-year low. I go back and I put my academic hat back on. Back in the day, I knew how to give letter grades. If I had to give a letter grade to the financial position of the household sector today, writ large, it's a solid B. Back during the financial crisis, or before the financial, it was a D. Okay, so I don't worry about that. In terms of the income inequality, what was interesting was if you look at the first coming out of the pandemic, actually heading into the pandemic, and then the first number of years coming out of the pandemic, wages at the bottom end actually rose more than they did at the top end. Because you think about it, just give an example. Remember back in say 2022 when restaurants started to open up again, you went into a restaurant and it took 20 minutes before anybody ever came up to you because they didn't have any staff. So how did they deal with that? They had to raise people's wages like crazy. So there was a little bit of a shrinkage there in terms of at least the wage gap. Now, the upper end of the income spectrum, those people get dividends and coupon payments and all that sort of stuff. And I'm not exactly sure what's happened to income inequality over the last 5 years. I'm going to guess it hasn't gotten any better, but it may not have gotten any worse either. But we still, in a 40-year sort of time frame, the income inequality in this country is the highest it's been in roughly 40 years.
Last question up there.
Good morning, sir. My name is Trey, and I had two questions actually. One is this PowerPoint presentation available to us, or is this something you're going to keep?
I'll give it to LJ. We'll make a PDF of it, and you're going to put it on your website or something?
Yes, and we would like you to share it with as many people as possible because I think it's important and I think it's worthwhile.
Make sure the disclaimers page on the back are part of it. Essentially says, ignore anything I just said.
I also have another question regarding the prediction models. That's a longer conversation. I understand that. But the other thing is, I was piggybacking off the previous gentleman's question was, we've gone over a lot of macroeconomics and explaining of the trends and everything, but what does this mean for the common household? Is that the stagnation, how long that inflation is going to be present, and how does that include to the debt-to-income ratio? Because ultimately, we're in a consumer economy, and 95% of the debt is held in households. So how does this work out for just the regular folk?
So, I guess if I look at the overall household sector, I talk about real disposable income, purchasing power. If you look at the amount of purchasing power in the economy today on a per capita basis, it's roughly 5% higher than what it was before the pandemic. People on average are 5% better today than what they were before the pandemic, on average. Right? That does, that means, Joe Blow over here may be 15% better, and James Smith over here may be 5% worse. Right? But and it gets back to the question before, when I look at the aggregate household sector today, and this goes back to Mike's question at the very, very beginning, what's the next recession? I'm not going to put the household sector in that bucket. Or if I am, it's going to be pretty low down the list of things that would keep me up at night worrying. As a matter of fact, I sleep very well at night. Thank you very much.
So with my privilege here as the moderator, let me ask you the most important question. Is the price of egg a direct response of eggs to the bird flu, or is it mismanagement?
Right now, it's largely bird flu. And a lot of the inflation that we had was because of supply constraints.
Thank you so very much. This is fantastic.